Joining us right now to talk more about all of this is Savita Subramanian. She is the head of U.S. equity and quantitative strategy at Bank of America Securities. And Savita, it has felt recently like the markets were really in a pretty good momentum, good mood on
Resilient.
All of these things that we've seen, these huge moves. How does this change the situation?
Look, I mean, I think this geopolitics are a bigger deal than what may be discounted into equities today. And I think it's interesting that crude rallied. The S&P is down a little bit less than the NASDAQ. I mean, here's our take. I think that we're in an environment where the real risk isn't necessarily in corporate America, but just in sovereigns and just the sort of uncertainty premium that we're seeing around the U.S. versus rest of world. I think the one advantage that the U.S. has, and one of the reasons that we've been more bullish on the U.S., is that the U.S. is energy independent, which comes into play in situations like today, where, you know, if you've got geopolitical risk that expresses itself in crude spikes, it pays to be an energy exporter, not an importer. So I think, you know, these are the kinds of aspects where we don't usually think about these as you know, equity strategists very rarely think about country risk premia, especially in the U.S. And all of a sudden this year, we've really had to start thinking about that.
How much of that is reflected in the markets right now? Because we have seen markets come, the S&P is less than 2% from its all-time high.
Right back where we started. I mean, I think that the areas of the S&P that may be, you know, a little bit overrun are areas like mega cap tech, in particular, you know, some of the communication services stocks, new media. Those are some of the most crowded areas of the market because we've seen tariff risk affect a lot of more multinational, global exposed companies in the U.S. I think energy is a really good hedge today. Energy equity is a good hedge against the environment that we're in because we've got geopolitical risk. We've got energy as a very under-owned sector. You've had a massive purge of energy stocks over the last couple of years. We're now at a point where energy is the most underweight it's ever been in our holdings data. And I think these companies have gotten religion. They're no longer supplying at the least provocation of a rise in oil prices. So this is a sector where I think you've got inflation protection, you've got dividends, it's cheap, it's not a big, you know, sell-off risk in a degrossing event. I mean, that's one of our favorite sectors. We upgraded it a couple of weeks ago just on the idea that how much worse can energy stocks do this year?
I guess I would point to the oil markets and their reaction to these things. Lima Croft was here earlier and said that oil traders have gotten burned by the idea that they thought these geopolitical risks were going to drive energy prices much higher. It hasn't happened after Ukraine with Russia because you still have supply that's there. All of this market, all of this oil that's on the market is being bought by somebody.
Yeah. No, you're right. I mean, and supply risks are prevalent. That's what's been driving oil lower. Maybe a global growth scare could affect oil negatively. But I think that when you look at the stocks in the energy sector, especially in the large cap energy sector, these are companies that have basically kind of decoupled from WTI. So, you know, the oil beta of the average energy company is about half of what it was in 2017. So I just see this as a world where you really think about, okay, we've got bond yields higher than we expected. We've got inflation still too high for the Fed to cut. What do you want to own? You want to own inflation protection. Mm-hmm. Bonds don't protect you from inflation. And if yields move higher, bonds are a terrible place to be in this environment. So I like equity income, especially from